It's that time of year again. Everyone's festive and joyous and optimistic, but maybe not for the reasons that you think. Everyone is so excited because it's Dogs at the Dow time. You see, every year investors from all over close their current Dow Dogs positions and generate the New Year's list. The Dogs portfolio is so fascinating because it's a rules-based strategy where you only have to trade on just one day of the year, the first trading day of each year. And then you enjoy your index fund beating returns, usually. Let's start by announcing this year's list of dogs. Dog number 1, Amgen Biotech. Number 2, Cisco Systems. Number 3, Chevron. Number 4, Dow Chemical. Number 5, International Business Machines, IBM. Number 6, The Coca-Cola Company. Number 7, 3M. Number 8, Merck Pharmaceutical. Number 9, Verizon Wireless. Number 10, Walgreens. So there you have it. That's the list of 2021 Dogs of the Dow. So please stick around and I'll show you how you can properly implement this strategy in your portfolio.
So there has never been a better time to have a diversified portfolio than this year. Actually, cash in that equation, the 25% of that portfolio that was cash, would have been a drag, would have cost you money. Oh my God, what do you mean? What do you mean? 15 to 17 million people out of work and cash is the loser? How could that be? Because the world doesn't work the way you think it's supposed to work.
If you watched last year's Portfolio Challenge results video, then you already know that the Dogs of the Dow had a pretty bad year in 2020. It lost around 13%, whereas the S&P 500 finished up around 14%. The Dogs don't always win every year, and 2020 definitely was a bad year. However, if we compare the 5, 10, and 20-year returns, the Dogs usually win by about 200 basis points on average. I know a 2% annual alpha doesn't seem like much, but compounded over years, it's an astronomically large amount of money. Okay, let's talk about the Dogs of the Dow rules. One of the most appealing aspects of the strategy is that it's rules-based. There's only a few simple rules to follow, and other than on that one day per year, you're not trading or actively managing any of your positions. You're going to want to use a stock screener to do this. I recommend FinViz. The first step here in the scanner is we want to set the index to the Dow Jones Industrial Average. Next, we want to click the Financial tab. And then we want to sort the grid by dividend descending. You're going to need to click the dividend column twice to sort in descending order. Okay, so there's actually 3 official rules to this strategy. Rule number 1 is to order all stocks in the Dow Jones Industrial Average by dividend yield, highest to lowest. Now we've already done that. Rule number 2, purchase the 10 highest yielding stocks in the screen in equal weighting, 10% each. Don't worry, I'll show you how to do this later with just a few mouse clicks. Rule number 3 is to hold these stocks for exactly 1 year and 1 day, and then rebalance into next year's dogs by repeating steps 1 and 2. Throughout the year, do not buy or sell any of these positions. Dogs of the Dow purists usually save their money throughout the year in high-yield savings accounts or money market funds, and then they make one big trade using all the cash that they saved throughout the previous year on the first trading day of each year. The reason the dog strategy works so well is because it piggybacks on top of the Dow Jones Industrial Average. The Dow Index has a really interesting backstory that I won't get into in this video, but please let me know in the comments if you'd like me to make a video on the Dow's history. What you really should know about the Dow Jones are these key points. The Dow Jones Index was created by Charles Dow, who also created Dow theory, also known as technical analysis. Charles Dow also created the Wall Street Journal, and the Wall Street Journal is responsible for managing the Dow Jones Index. Unlike most indexes, the Dow is price-weighted, not cap-weighted. So this means that the Wall Street Journal has to constantly rebalance the index to account for the wide price variation between stocks. In order to be considered for inclusion in the Dow index, a company has to pay a dividend. That's why companies like Amazon and Google are absent from the Dow. Since there are only 30 stocks in the Dow Jones Index, and all of these stocks have been heavily vetted by the Wall Street Journal, the Dogs of the Dow strategy benefits from having a good pool of stocks to pick from in the first place. The idea of this strategy is that stocks that are in the Dow that are doing poorly won't be doing poorly for long. So if you buy the ones that are the worst performers today, then the odds are that they will bounce back. An added benefit is that their dividend yields are typically really high, so you have a chance for a real double whammy, both getting a high dividend payout and capital gains appreciation. The dogs should all be equal weighted, 10 companies with each position being 10%. If you use the M1 Finance brokerage, then it's really simple to play around with strategies like this, since you can just add them as a small slice within your overall pie. Just follow the M1 link in the video description to add the 2021 dog slice into your pie if you'd like to follow along. So what are my final thoughts about the Dogs of the Dow? Well, personally, I really like the Dogs of the Dow strategy, even though it did get killed in 2020. This portfolio is definitely going to be one of the portfolios that I feature in my 2021 portfolio challenge. So be sure to subscribe if you want to follow along and see how this strategy performs throughout the year. Also, as a sidebar here, I'd be interested to hear what you guys think about the Dogs of the Dow strategy. Have you ever tried it? Has it done well for you? What are your thoughts? Anyway, thanks for making it all the way to the end of the video. I appreciate it. We'll talk to you next time.